Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Aurora Innovation Inc. Annual Report. Aurora Innovation Inc. is a leading provider of self-driving technology solutions in the United States. At its core, the company focuses on developing Aurora Driver, a comprehensive platform that integrates hardware, software, and data services to enable seamless adaptation and interoperability across various vehicle types and applications. The company's expertise lies in creating cutting-edge autonomous driving technologies, which are essential for transforming the transportation industry. With a strong presence in Pittsburgh, Pennsylvania, Aurora Innovation is well-positioned to drive innovation and growth in the self-driving technology sector. Aurora Innovation's services include developing and integrating self-driving hardware and software, providing data services to support autonomous vehicle operations, enabling interoperability across various vehicle types and applications by offering these innovative solutions. Aurora Innovation is poised to revolutionize the transportation industry and pave the way for a safer, more efficient, and more sustainable future. Aurora Innovation, Inc. has experienced a significant decline in its stock price, exceeding 53.72% over the past year. The primary causes of this crash can be attributed to several key events and contributing factors. One major factor was the company's persistent financial losses and concerns over profitability and scalability. Despite achieving operational milestones, Aurora consistently reported significant operating losses and negative cash flow. In Q3 2025, the company recorded a staggering $222 million operating loss against just $1 million in revenue. This led to a rapid depletion of cash reserves, with a drop of $120 million in Q3 2025. Another contributing factor was the negative market sentiment fueled by bearish reports and valuation concerns. A report from Carisdale Capital echoed concerns regarding the company's valuation, further contributing to negative sentiment. Additionally, retail investor sentiment sharply declined in December 2025, moving into bearish territory on platforms like Reddit. The company's inability to scale its commercial operations also raised questions about its pace of commercialization. Management commentary suggested that scaling would be a time-consuming process, which added to the concerns over profitability and scalability. Furthermore, legal disputes related to autonomous vehicle technology patents and broader market pullback and tariff concerns also contributed to the sustained downward pressure on Aurora's stock price. The combination of these factors led to a significant decline in the company's stock price, with the share price falling from $10.19 to $5.80 by September 2025. The continued cash burn, lack of profitability, and negative market sentiment ultimately resulted in a total crash of the stock price over the past year. Aurora Innovation, Inc. maintains a market capitalization of $8 billion, broadly in line with the industry peer group. Aurora Innovation, Inc. trades at a higher price-to-book ratio of 3.67 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 12% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company are multifaceted. On one hand, revenue growth is driven by several key factors. The commercialization of self-driving technology has been a significant contributor to revenue growth, as seen with the launch of Aurora Driver for freight in April 2025. Strategic partnerships with industry leaders such as PACCAR and Volvo, Toyota, and Uber have also played a crucial role in driving revenue growth. Furthermore, the adoption of the driver as a service (DaaS) business model has been instrumental in generating revenue. In addition to these factors, the company's ability to generate revenue from its trucking product has provided a draft on revenue and technical capability for passenger mobility and local goods delivery markets. This has enabled the company to expand its reach and increase its revenue streams. On the other hand, there are several drivers of revenue decline that the company must be aware of. Technical challenges in commercializing self-driving technology have hindered revenue growth, as have limited operating history and transition from R&D focus to commercial activities. Delays in technology development and commercialization have also contributed to revenue decline, as has competition and pricing pressure in the market. Furthermore, changes in consumer confidence and economic crisis can impact revenue, as well as evolving laws, regulations, and industry standards related to artificial intelligence and machine learning technologies. Governmental enforcement inquiries, investigations, and other proceedings and actions due to non-compliance with regulatory obligations can also lead to revenue decline. Net income has been a persistent concern since the company's inception, with a steady decline from -$748 million in 2024 to -$816 million in 2025. This downward trend is largely attributed to significant expenses incurred during development and commercialization phases. As a result, profit margins have remained low, indicating potential scalability issues that hinder profitability. The primary reason for this change lies in the company's approach to scaling its operations. By investing heavily in development and commercialization efforts before generating substantial revenue, the company has inadvertently created a financial burden that outweighs its income. This strategy may be necessary for growth, but it comes at a significant cost, resulting in negative profitability and decreasing profit margins. The company's financial performance indicates a consistent trend of negative operating cash flow. According to the provided data, the net cash used in operating activities has been significant over the past 3 years. In 2025, the company utilized $581 million in operating activities, while in 2024 and 2023, it was $611 million and $598 million respectively. These figures demonstrate a substantial outflow of cash from operations, suggesting that the company is not generating sufficient positive operating cash flow to meet its financial obligations. The company's debt level has undergone a significant transformation in recent years. A notable decrease in total debt from $263 million in 2024 to $203 million in 2025 indicates a reduction of $60 million, demonstrating the company's efforts to manage its financial obligations. However, interest expenses are not directly reported, but an increase in long-term investments classified as debt securities suggests that the company may be taking on more debt. The total increase in these investments is $306 million, which could potentially lead to higher interest expenses in the future. The performance of various segments and regions is expected to differ in the upcoming commercial operations. In terms of segments, local goods delivery is anticipated to perform well, while ride-hailing and trucking do not have any specific performance expectations mentioned. Geographically, the United States is seen as a key starting point for commercial operations. This suggests that the company will focus on establishing a strong presence in this market before expanding into other regions. International markets such as Canada, Europe, Japan, Australia, and New Zealand are also expected to be targeted for expansion, indicating a global growth strategy. The company's management is optimistic about the future outlook, emphasizing the need for safe, quick, and broad deployment of self-driving technology. To achieve this mission, they plan to commercialize their technology through a driver-as-a-service (DaaS) business model, which will enable asset-light and high-margin revenue streams. The company expects to generate revenue from various sources, including passenger mobility and local goods delivery markets. However, it also acknowledges that it will continue to incur operating losses and may need to raise additional capital to support the development and commercialization of its technology at scale. Despite these challenges, management is confident in their ability to navigate risks and overcome obstacles. They have secured a strong equity capital raise of $898 million through the ATM program, which has improved cash flows and provided a solid foundation for growth. While regulatory hurdles, cybersecurity threats, and competition from other self-driving companies pose significant risks, management remains committed to delivering on its mission and achieving long-term success. The company's financial strategy has been a topic of interest for investors. A key aspect of this strategy is its approach to distributing profits to shareholders. According to available information, the company has not paid dividends to its shareholders. This decision suggests that the company may be prioritizing other uses of its profits, such as reinvestment in the business or debt repayment. The absence of any mention of share buybacks in the provided summaries further indicates that the company is not currently engaging in this practice. Overall, the company's financial strategy appears to be focused on internal growth and development rather than distributing wealth to shareholders through dividends or share repurchases. There are valid concerns about inventory buildup or supply chain disruption. The COVID-19 pandemic has already caused disruptions to global supply chains, leading to shortages and delays. Furthermore, changing consumer behavior is also affecting the supply chain, making it challenging for companies to adapt. The risk of single-source suppliers, potential shortages, long lead times, and industry consolidation are all contributing factors to supply chain disruption. Additionally, changes in trade policies, tariffs, economic sanctions, and ongoing geopolitical tensions are causing uncertainty and instability in the global supply chain. Trade policy changes and potential tariffs/restrictions on components used in hardware are also a concern, as they can limit access to essential materials and increase costs for companies. These factors combined create a perfect storm that could lead to inventory buildup or supply chain disruption if not addressed promptly. That concludes the financial summary for Aurora Innovation Inc. Feel free to comment below, and I will be happy to answer them when possible.